Jobs report is out, recession indicators, and have we found a new normal for interest rates? This is the weekly report on Major Money Matters. All right, welcome to another week, and we got another week under our books, and it's a pretty volatile market. A lot of changes happening in the market right now, but we want to address a couple of things as we wrap up the week, and as many of you are going out still looking for houses and trying to get under contract. And I'll wrap up with a note to my realtor partners that get this also. So let's look at the charts here. We bring up the charts. We look at, we're down a little bit on today on basis points. However, you'll see over the last 3 days, we kind of have gotten to the plus side on mortgage-backed securities. And we started trended to the upside on the last 3 days prior to today. So if we look at this, those of you who have seen this before, know that as this chart trends downward, interest rates go up. So at the beginning of this week, we started to regain some traction and possibly head higher on this chart, which would indicate lower interest rates. However, today, it's kind of like the drug game. You try to get out and pulls you back in. We're down again, big time today, and trending back into, the negative land for mortgage-backed securities. But the good news is this: it appears that we've kind of mellowed out into a comfortable range while we've been trying to figure out where is the bottom on mortgage-backed securities and where is the top for interest rate. It appears that, at least in the short term. So we're in a pretty good spot now, and we've mellowed out here. And I'll tell you where rates are pretty much standing. If you're in a VA loan, you're pretty much in the mid fours, somewhere in the 4.4 to 4.6 range on VA. If you're VA high balance working with my team, you 900 plus, you're probably in the 4.0, 4.1 range because of the way my company structures our loans. We get better rates on VA jumbo. If you're in the conventional world, you're probably looking at rates in the 4.9 to 5.0 range on conventional. It's a challenging season for conventional because conventional has been hit the hardest as we have trended towards these higher interest rates. So I did do a video this past week and uploaded it to my channel, the real reason that interest rates are rising. So that video is available, so you can go there. If this is your first time you're seeing this or you're new to the channel, you go look at that video and I explain in depth why interest rates are rising. But let's take a look at a couple more things. Jobs report this week. So we got the jobs report this week, and the jobs report was very, very strong and it looked great. However, you should know about this chart also. Some specifics on the jobs report, by the way. We went from 3.8% unemployment to 3.6% unemployment, looking pretty strong there. Unemployment almost at its all-time low. However, I want to throw up this chart. This is the unemployment rate as it relates to recessions. Now, if you've seen any of my previous weekly reports, I have been consistent in saying that I believe that we're heading towards a recession. Now, why does that matter to you if you're looking for a home? During recessions, housing prices tend to continue upward or remain stable while interest rates go down. So if interest rates trend down, you can see that it's beneficial for you to get into a property now and potentially refinance that property or refinance your mortgage when interest rates go down. So I have been consistent in saying that I feel, my personal belief, along with some economists and some advisors that I listen to, feel that we're going to be in a recession sometime near the end of 2022 potentially, or the beginning of 2023. Perfect opportunity to refinance your home, but get into a home now as the prices are continuing to go higher, and then you could refinance that home a little later on. All right, so we look at the unemployment rate as it ranks to recessions. So if you look at this chart carefully, you will see that at the bottom of these cycles, when the unemployment rate starts to rise, that is when we go into a recession. Unemployment right now at almost at an all-time low. We went down, according to this month's jobs report, another 0.2 of a point, currently at 3.6%. So when you see that unemployment rate start to tick up, then that's when a recession is likely on the horizon. Now, if you think about this makes sense. Unemployment rate starts to tick up. People start getting laid off from their jobs, or people start losing their jobs. And then the next thing that happens is those people decrease their spending because they're unemployed and they're not putting funds back into the economy. They're decreasing their spending. And then those that are left at the job are also start looking at their spending and say, hey, maybe I shouldn't spend as much. And that's less money into the economy. So, when you see the unemployment rate start to tick up, that's when a recession is likely on the horizon. Now, when could that be? Maybe 12 months, maybe 16 months now. But it does not make sense for you to say, hey, I'm going to wait to get into the housing market later when the interest rates go down and we go into recession, because we've seen this. We've seen the madness that was when interest rates were at their all-time lows. Interest rates are low, meaning people can qualify for more. You have a lot more competition. Now, it's competitive out there now, but if interest rates go down again, it's going to be all bets off, and it's going to be a flood. So I encourage you, if you're looking for a home, go ahead and get into a home now while interest rates are pretty reasonable, but not really as low as they used to be. But interest rates are still at a reasonable mark. So that's something to keep in mind. So that's the weekly report for this week. Keep in mind that you can look at other videos that we have online. You can look at other things that are going on in the market through our YouTube channel. And we try to keep you informed and keep you educated as you're out there looking for homes. Now, if you are a realtor, if you're a realtor and you're working a listing as a realtor, if you have a pre-approval letter and that pre-approval letter is a month old or 2 months old, I'd recommend you do a lot of digging before you accept that offer, because it's possible that that person has not spoken to their loan officer in a month or 2 months, and that interest rate is significantly higher than it was previously. And the last thing I want anybody to do is to get into escrow and then fall out of escrow. So keep in mind, if you're working a listing, you get a great offer and you think it's a great offer on a property, you probably should call up the loan officer on that deal. Everybody does not do as good of a job as we endeavor to do with keeping people informed of what's going on in the market. So make sure you're checking with the loan officer and ensuring that you're actually have run numbers with interest rates being a little bit higher and they are comfortable with that payment. So God bless you. I will see you next week. Let's get out there and get under contract and get into some homes. God bless you. See you next week on Major Money Matters.